This is the Asia Trade. I'm Paul Allen in Sydney, where the markets just opened. The top stories this hour. Asian stocks set for a weaker open as traders brace for the Fed's last rate call of the year. A cut is widely expected, but the outlook for 2025 looks much less clear. Honda and Nissan reportedly set to open merger talks that could produce a rival to Toyota as the global auto industry grapples with rapid transformation. And with Chipmaker Kioxia set for its Tokyo trading debut, we'll take a look at Japan's IPO pipeline for 2025. Well, just opened for trade here in Sydney. We've got the ASX kind of flat at the moment, not to be unexpected though with the staggered open. We will get the mid-year economic update from the government today. That's not expected to be a particularly pretty picture, with the budget expected to be forecast to sliding back into deficit. But not a lot of movement really ahead of the Fed decision. We've got Nikkei futures also looking flat. The yen moderately stronger at 153.40. If we take a look at US markets, we did see modest declines on all the major indexes ahead of that Fed decision. Yields barely moved as well, sort of hovering around 1 month highs. We've got Nasdaq futures looking a little bit softer. S&P futures are pretty much flat. Crude price gaining. This is despite Kazakhstan planning to increase output in 2025 against the wishes of OPEC and its agreement to curb production. We've also had incoming President Trump signaling a plan to sign an executive order on day one to promote domestic US production. A few things we're going to be watching in Japan today, however. We do, of course, have the Kioxia IPO, but grabbing a lot of headlines is this report from Nikkei of preparation between Honda and Nissan to start negotiations on a possible merger. We saw ADRs in both stocks rising in the US, Nissan in particular, up by more than 11%. So this would give scale for both of those companies to create a rival to Toyota, also to compete with international car makers as well. So for more on this, let's get to Bloomberg Global Business America's senior editor, Chester Dawson. So Chester, this is a better deal for Nissan or for Honda?
Well, it's probably going to be a good deal for both of them, but Nissan is the one that's in much worse financial condition and desperately needs to latch on to a partner, and it looks like Honda's going to be it. Honda itself, has always been proud of its independence. It has had a link with General Motors of the U.S., but that has weakened in recent years. So this seems to make sense for them to kind of combine forces and compete more globally.
So if we do end up with a combined Nissan-Honda company, how's that going to rank in terms of global output?
Yeah, that's a good question. It will vault them ahead of the likes of, say, General Motors, but still be somewhat shy of say, Hyundai, and far, far shy of their biggest domestic rival, Toyota, which is also the world's largest. So it will position them a little better, but it's not about to put them at the very top of the pile.
So we've already had Honda and Nissan agreeing to cooperate on EV battery technology. So to what degree is this closer relationship a reaction to threats posed by Tesla and Chinese automakers?
That's a very good point. The entire auto industry, at least the established legacy automakers, are fretting what it means to be behind Tesla and very competitive Chinese companies like BYD when it comes to electric vehicles, which, despite some slower growth, the industry still sees as the future for the auto industry. So this is probably, in that context, a move that's designed to shore up their resources to jointly work and try to combat, not only in key markets like China, but right around the world, to make sure that Honda and Nissan have a stake in the future that's increasingly looking like one dominated by EVs.
All right, Bloomberg's Chester Dawson there on the potential Honda-Nissan tie-up. Well, investors are bracing for the Fed, of course, and the BOJ's final policy decisions for the year. So let's get a preview of this with Garfield Reynolds, who leads our Markets Live Asia coverage. Garfield, let's start with the Fed. We're going to hear from Jay Powell, of course. A new set of dots might indicate just 2 cuts for next year. We've also got economists lifting forecasts around inflation for next year. Is there an argument for a pause tomorrow?
there's an argument for a pause, definitely. It seems extremely unlikely that anybody would actually be listening to such arguments. And the Fed, over many, many years, the Fed has usually been extremely shy of going into a meeting and taking a contrary position to what it's allowed to have priced in. So seeing as we've got 95% odds for a rate cut, for them to pause would be such a huge shock that there's no point going through with it. To be honest, even if you think that there are some, and there's definitely grounds thinking there are some serious risks about a revival in inflation, pausing here wouldn't really do all that much to safeguard against that. It would be more, in both events, in any event, what really matters is what they say about what's coming up next year. And I think there's two things about that. One is, even if the Fed sticks with 3 25 basis point cuts for next year as the dot plot, there's going to be plenty who are still going to doubt that, because if the Fed does stick with that, then that means that they're mostly not trying to incorporate what they think the Trump's policies might bring. Possibly they're not even trying to think about what the expected continuation of the corporate tax cuts will bring to the deficit and to the economy. So there'll be a lot of people second guessing them, even if they stick with their knitting, as it were. People are going to say that's a kind of a false hope, that they are going to have to do less unless the economy really starts to seriously go sour next year.
We've seen US Treasury yields sort of stalling out around 1-month highs ahead of this decision. What is the bond market telling us about what's coming next?
Well, the bond market is telling us that they're not quite certain where they should go. I think they will be looking for some reassurance from the Fed that they think they've got things under control. But even then, it's a bad setup for bonds if Powell is right that they're going to engineer a soft landing, because a soft landing is going to mean an end to rate cuts sooner rather than later. It's also bad for the bond market if those worries are going to persist that when Trump gets in and imposes tariffs, cuts taxes, that those things are going to boost yields again. There's also the concerns about Treasury Secretary-elect, or the nominee for the Treasury Secretary, Bessent, his plans to slash T-bill sales and instead fund more through bond sales. That also puts upward pressure on the yields. So there are a lot of concerns there, and as you would have noticed from what I was outlining, a lot of them don't actually have that much to do with the Fed. They're to do with what's going to come after January 20, once Donald Trump is back in the White House.
Mm-hmm. Let's talk about the Bank of Japan as well. Of course, we're closing in on the decision there. Also, no change expected. What are we expecting in terms of commentary, though?
Well, that's the difficulty under Ueda in particular, that, gradualism, more times than not, no change is what it seems you're going to get as far as the decision goes. But there's the potential for a lot of volatility, both because Ueda already has a track record of taking back or adding on from the statement, what the statement is seeming to indicate could be one thing, and then a few hours later, and there is quite a delay between them when the decision comes out and when Ueda actually gives his presser, and surprising one way or the other. So plenty of potential for volatility in that. Again, the outlook is likely to be what matters, and in particular how open they are to going several times next year, how confident they are that they are going to be able to normalize next year, and how they dance around this issue that the relatively new Japanese government has made it clear they want the BOJ to take their considerations into account. So how independent can the Bank of Japan be in that situation? And therefore, even if a waiter does say he wants to hike rates, how certain is it that traders, how certain can traders be that he will? So, as I said, that creates a lot of potential volatility, especially because we've already got thinner liquidity now, just globally, because a lot of people have already signed off for the year, either because they've taken their holidays or because they've squared off their positions, before that last week when there's nothing around. So that adds the potential for some extreme moves, especially in the yen, which we've seen numerous occasions this year. When it gets going, it moves like a freight train.
All right, Garfield Reynolds, who leads Markets Live Asia coverage. Thank you. Still to come on the Asia trade, we're going to get the outlook for regional IPOs in 2025 with EY, who see a healthy pipeline of new listings on the way. And we'll have more on the potential Honda-Nissan merger with Macquarie Capital. Plus, Invesco gives us their investment playbook with the Fed in focus and Donald Trump heading back to the White House. Much more ahead. This is Bloomberg.
I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariffs and stuff, but wars. What happened in the Middle East this the week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States.
Bank of America CEO Brian Moynihan there, speaking exclusively to Bloomberg. Let's bring in Lauren Saidel-Baker, economist at ITR Economics. Lauren, it's not just a straight-up rate decision that the Fed has to consider today. It's a lot of known unknowns and unknown unknowns for 2025. What are the risks for the Fed next year in terms of unintended consequences from tariffs and trade and other conflicts?
I think the biggest unintended consequences is to inflation. We at ITR Economics have been expecting inflation to mount for fundamental reasons in 2025. So I think tariffs would really just add fuel to that fire, really up that inflation level that we're seeing in the back half of next year. I don't think the Fed is going to have too much room to cut deep into 2025 for fundamental and other politically imposed reasons. But as for the known unknowns, a lot is still yet to be seen. The difference, say, between a policy proposal from the incoming Trump administration and maybe campaign rhetoric that might be left on the campaign trail.
So you've got a forecast for higher inflation. What about some of the other key metrics that the Fed will be watching? I mean, growth's looking pretty robust in the US at the moment. So's the jobs market, and we just had some pretty decent consumer confidence numbers as well. All this seems to add up to a higher for longer scenario.
It certainly does. Growth is certainly strong, stable, and seems to be in an uplift. We've seen leading indicators come in suggesting accelerating growth by 2025 in terms of GDP, the industrial economy really looking to pick up steam. And the consumer is in a stable position. So consumer spending fueling about 2/3 of GDP. That all at the end of the day comes back to this tight labor market. That is the other half of the Fed's dual mandate. So they don't want to see further deterioration, as they've said, in the labor market. I just don't think they're going to see that in any real form due to some demographic trends. We still today in the United States do not have one unemployed worker per each available job opening. And for demographic reasons, just the size of the incoming Gen Z who's now aging into the labor force, as well as very high labor force participation from our prime age participants, there are just fewer folks left on the sidelines to take up these jobs. I don't see much more deterioration on the horizon for the labor market, and businesses really will be needing to hire to meet this incoming demand that we see by 2025.
So in terms of what's in front of us this week, I mean, we're pretty much nailed on in terms of 25 basis points of easing, but there's a lot of commentary around describing this as a hawkish cut. And for 2025, I beg your pardon, we've got a chart here that illustrates we've only got 3 cuts priced in now. Based on what you're saying, what are the risks to that scenario? Could we see fewer, perhaps?
I think we could see fewer than 3 cuts, very likely, in 2025. I really see the major risk being for rate hikes, potentially by the end of the year. So that is not our base case, but I don't think that's a completely outlandish statement to make, that we could start to see rates creep higher by the end of next year.
A potential for rate increases by the end of 2025. This sounds like it would be setting the scene for a showdown between the Fed and incoming President Trump. How do you gauge the risk of political interference in the Fed's mandate?
Yes, there's clearly some bad blood between those two individuals. In a recent press conference, Chair Powell was very clearly asked if could President Trump essentially force him out before the end of his term? It seems that there's no legal mechanism for that to happen. Chair Powell has said that he won't step down if asked to by President Trump. So we at least should expect to see Chair Powell until 2026. Now, at that point, who would be the next nominee? Really a lot of uncertainty behind that factor. So a little bit more certainty here in the near term, but political interference is a real risk. A lot of the norms with regard to the Federal Reserve, they're not codified into law. They're just norms and how things have always been done. So we're watching that. I think there would be some legal challenges that hopefully would at least delay any real interference, but something to watch going forward.
Yeah, Jay Powell was pretty clear that he's not going anywhere before his term ends. But do you think the market is adequately prepared for some sort of political difficulty between the incoming administration and the Fed?
I would expect to see some talk, right? Words do tend to fly when Trump comes into the equation. He clearly has an idea of where rates should be that maybe are not completely on board with the Fed officials. So sparks will very likely fly, but as for actual policy, that does seem pretty protected, again, at least here in the near term.
So we've got a very strong US dollar at the moment. What's your forecast for dollar strength heading into 2025 as we do see rates diverge, particularly between the Fed and the BOJ?
Sure. I think dollar strength is very well founded. We see a lot of foreign direct investments still coming into the United States. That re-onshoring, nearshoring, I think that will only be accelerated by this talk of tariffs. Folks really do want to do business here in the United States for fundamental reasons. And once you add that nationalism flair on top of things, there is some pullback to domestic sourcing. So I think it makes sense that a lot of money is trying to find a home in the dollar. Central bank policy clearly adds a nice layer of complexity to that. But fundamentally, money is looking for the United States. We do see those foreign direct investment flows continuing for non-political, very fundamental reasons.
You might have heard us talking before with our Markets Live editor Garfield Reynolds about the increasing amount of US Treasury issuance that might be coming. Brian Moynihan also was talking about his concerns about the amount of debt in the US. The deficit exceeds the entire GDP of Australia. Do you have any concerns about the size of the debt, the ability of the US to keep on top of an ever-mounting interest payment bill?
I do have very fundamental concerns about that. Now, not in the near term. I think 2030 is really when we'll see those chickens come home to roost. But nearer term, we do expect that additional Treasury issuance just to cause some liquidity that tends to be more inflationary. So again, more fundamental upside pressure on price changes. But for the actual longevity of the deficit, right, the viability of us continuing down this road, I think we have several more years that we can continue to kick that can down the road. By 2030 is when I'm looking at our demographics getting into a very troubling position and really looking at some broader implications on the macroeconomy from that level of deficit and debt.
We're going to get a new set of dots as well, considering your remarks a moment ago about the potential for rate hikes by the end of 2025. What are you expecting the dots to reflect?
We've seen the markets start to expect a little bit more inflation to come next year, so I wouldn't be surprised for at least certain Fed officials to maybe start to temper their expectations again. I don't expect any wholesale change. They're watching the same numbers that we see. They see this continued disinflation. They see the broad strength of the labor market. So I'm not looking for a wholesale change. I'm not looking for us to flip a switch with this dots plot, but we do tend to see the sentiment shifting more in that direction. So I wouldn't be surprised to start to see some of those dots maybe leveling off or even creeping back up.
All right, Lauren Saidel-Baker, economist at ITR Economics. Thanks so much for joining us. Now, subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about, and you can become part of the conversation by sending us instant messages. You can check it out at TV Go. Got some breaking news for you regards Nissan Motors. Perhaps not surprising, shares suspended on the Tokyo Stock Exchange. Why? Of course, we do have this report from Nikkei that Honda and Nissan preparing to start negotiations on a possible merger. That news saw Nissan ADRs pop by more than 11% in the US. So this would give that tie-up great scale to create a rival to Toyota, also help it compete with international car makers. So Nissan suspended heading into the open today. We'll still be keeping an eye on Honda, though. Those shares were also up, or ADRs also up in the US by almost 1%. Let's get to some of the top political stories that we're tracking. Israeli officials say a ceasefire in Gaza, more likely now than at any time in the past year. A working group from Israel is in Doha this week to re-establish relations with mediators. Two officials told Bloomberg the proposed deal would come in stages, starting with the release of some hostages and Palestinian prisoners. A ceasefire would then follow to allow aid into Gaza and talks on a permanent truce. And we'll be speaking with US Secretary of State Antony Blinken about developments in the Middle East and Ukraine, as well as what foreign policy might look like under a second Trump administration. You can catch that interview live on Thursday at the Times on your screen. Now, the US is said to be gearing up to initiate a trade investigation into Chinese semiconductors in the coming days. Sources say the review could result in tariffs or other measures to restrict imports on older model chips and the products that contain them, such as cars and smartphones. The investigation could take months to conclude, with any reaction left to Donald Trump's incoming administration. The son of Thailand's king says the monarchy needs to listen to all opinions about the institution's future. 43-year-old Vajiralongkorn Vivekcharoenwong returned to Thailand from exile in the US last year, in a sign that he may be considered a possible successor to King Maha Vajiralongkorn. Thailand's strict lèse majesté laws threaten lengthy jail sentences for anyone who criticises the monarch. While Vajiralongkorn wouldn't comment directly on whether or how he'd change Article 112. In a rare interview, he did tell Bloomberg that he believes in freedom of speech.
There's place for every opinion. If you don't listen to logic or to understanding or arguments of another side, I don't think you can really say you can reject.
Thailand's Bureau of the Royal Household did not respond to Bloomberg's written questions. We have more to come on the Asia trade. This is Bloomberg. Japanese chipmaker Kioxia makes its trading debut in Tokyo today after years of complex and wide-ranging negotiations that involved stakeholders and the government. But investors may be wary due to a whole range of concerns. Japan stock reporter Alice French joins us now. So, Alice, what are we expecting from the IPO today? Demand perhaps not what might have been hoped for.
Yeah, so like you say, this has been a long-awaited IPO. We know that Bain first tried to float the IPO in 2020, but that was scrapped. I think it's fair to say that demand is lukewarm at the moment. We've seen the shares priced slap bang in the middle of the range that Kioxia had suggested, which is in contrast to most big IPOs that we've seen in Japan this year have been priced right at the top of their range. So this does indicate perhaps some wariness amongst investors like you say. The main concerns seem to be that the NAND flash memory chips that Kioxia makes, they're undergoing a kind of slump in prices right now. So there are some concerns about how that might impact Kioxia's future earnings. And so investors perhaps sort of pulling back a little. Having said that, this is a chip company. It is a hot sector. And we did actually hear in Tokyo yesterday that some traders were even selling shares in some other chip companies like Advantest to kind of free up some space in their portfolio for a Kioxia buy. So, it's fair to say that there'll be interest, but also wariness at the same time. It'll be interesting to see how the shares perform today.
So the timing's not fantastic either for this IPO. What are we expecting in 2025 for the chip industry, particularly in the context of the incoming Trump administration?
Yeah, you're right. I mean, not just in Japan, but worldwide, right? There are some concerns about the future of the chip industry as Trump takes office in the US with promises of a lot of tariff hikes on China. We have seen some kind of depression in Japan's chip sector in the last few months since Trump took office, with investors actually moving some money out of those kind of hardware plays like chips and more into slightly more insulated, geopolitically insulated stocks like gaming and software. Having said that, the AI boom is obviously ongoing, and there will still, of course, be high demand for chip and chip-adjacent investment going into next year. But there's definitely a lot of sort of uncertainty in the sector, and Kioxia will be a part of that. And I'm sure that that will be fueling investors' wariness today as well.
So what does this debut tell us about Japan's IPO market more broadly? Because 2024 was a pretty big year.
It is, yeah. We've seen some pretty big debuts this year. Perhaps most notably, a couple of months ago, we saw Tokyo Metro debuting. There was a lot of demand for that one, and that one did very well. But yeah, in total, IPOs in Tokyo have made almost a trillion yen in 2024, which is pretty much back at pre-pandemic levels. The number of companies debuting has actually been lower than we've seen in recent years, but the total raised is high. This obviously, it bodes well ahead of 2025. We have some pretty big names set to debut next year too, including BitBank, which is a crypto firm. And of course, this all plays into this sort of overall theme of activism and increasing M&A in Japan, this kind of increasing dynamism in the market. And it may, help to encourage more activists if things like the Kioxia debut today goes well. It kind of indicates to activists that there are options to exit successfully if they make that move to invest. And so this kind of all plays into the wider theme that we're seeing. And I think Kioxia will be watched very closely today as a measure of the overall IPO market. So, yeah, it'll be interesting to see.
All right, Japan stock reporter Alice French there. For more, George Chan, global IPO leader at EY, joins us now exclusively from Hong Kong. George, you recently put out a report on IPO activity across 2024, and if we take a look at Japan, it was kind of middle of the pack there. Alice mentioned a trillion yen's worth of money raised. I think there were 84 listings, mostly in the tech sector. What about this Kioxia debut today? Do you see that providing some momentum heading into 2025?
Thank you for having me this morning. And to be honest, Japan's IPO market was considered as moderate in 2024 because the Nikkei has reached its peak and becoming stabilized. But looking into the 2025, there are mixed signals from our read. Basically, a lot of consensus has been reached that Japan's economy is about to rebound, gently rebound, which is a good sign. The monetary policy has shifted. So, but at the same time, we are seeing geopolitical tension, just like tariff issues. And also, Japan has fundamental problem with the aging populations and also the lowering of birth rate. So all in all, from economic perspective, I think the companies in Japan will probably be reporting good results in 2025, which will probably fuel the IPO market. But at the same time, we need to watch it carefully about the macro environment around Japan's economy.
Well, tech and AI-related companies did see a lot of IPO activity, not just in Japan, but in almost all markets. Can you give us a sense of the scale of what we saw in terms of those sorts of listings and whether or not you see that trend continuing in the next 12 months?
Yes, in short, I would say the 2025 IPO market will gradually recover, picking up the momentum from 2024. But to be honest, we are seeing a more diverse regional ecosystem IPO landscape. Take Asia Pacific, for example. Even within Asia Pacific region, we are seeing China slowing down in the IPO activity, where Hong Kong has reversed the trend of picking up momentum in the IPO market. This is mainly because China, we are observing they are still implementing a policy-driven capital market regulations. What they are trying to do is they are trying to limit the number of IPO, but at the same time strengthening the quality of all the existing listed company or future listed company at a moderate pace. At the same time, Hong Kong market has become the #1 destination of all the Chinese company who wants to tap onto the IPO market, and the Chinese government is actually encouraging it. So in short, we are seeing IPO boom around the world, but we also need to take a look at individual regions and the ecosystem within that region to determine the 2025 IPO landscape.
Yeah, your report showed that the Chinese mainland did experience the lowest IPO activity in a decade, and you point out the desire to focus on quality going forward. Do you feel the policies are in place to achieve that goal?
I do think so. The Chinese government has implemented a basket of economy stipulate policy. One of them is actually to reform the Asia markets. And we are seeing a lot of good companies getting debut on the Asia market with good profitability. And the market sentiment in Chinese stock market is still there. So we are seeing gradual improve in the liquidity and also the valuation in the Asia stock markets.
Well, the US reclaimed the top spot globally for IPO proceeds in 2024. As we enter an environment of declining rates, albeit perhaps more modestly than we thought, do you anticipate this giving a tailwind to IPO activity in the US?
I do think the IPO activity in the US in 2025 will continue to be quite strong. We have seen a lot of pipeline, and also with the election year over, which is a major uncertainty that most CEOs, they do not like. And I do see a lot of strong pipeline company, they are lining up to tap on the US market, given we are still expecting the interest rate to be coming down in the next year. And also the general economic conditions and all the indicators, they are still maintaining a strong position.
Well, it might surprise nobody to learn that in terms of the country-specific story, it was India that rose to #1 for IPO volumes. Do you see that momentum being maintained?
I would think so. India is a very special market. Pretty much they are dominated by retail investor, and the market sentiment is still there, and their economic numbers, they are still growing quite strongly. And in 2024, we have seen the aftermarket performance of all the IPO debut to be quite good. And I do think the momentum is going to be carried into 2025. And we expected another strong year for India in 2025. One of the most important things is I do think they are the beneficiary of the current geopolitical tensions. So a lot of economic inflow and foreign investment is going to tap on the India market.
All right, George Chan, Global IPO Leader at EY. Thanks so much for joining us today to talk about your report from 2024. All right, we do have the Australian Treasurer Jim Chalmers speaking at the moment. Well, that is actually the Finance Minister Katie Gallagher that you see there, but Jim Chalmers just finished with his remarks. The reason being, we have the mid-year economic and fiscal outlook just being released. It was grim reading. We were expecting grim reading. We're going to be returning to deficits in Australia, a forecast deficit of $26.9 billion this year. That's an improvement on the $28.3 billion deficit that was forecast back in May. Now, this also assumes an iron ore price falling to $60 per tonne. We're well above that at the moment, but the budget estimates tend to be quite conservative when it comes to the iron ore price. Migration, which has really provided a major tailwind to the Australian economy, that's assumed at 225,000 from fiscal 2027. Overseas migration seen at 340,000 versus 260 to the end of May. Net debt, meanwhile, that's estimated to rise to 22.4% of GDP. This is 21.9%, an increase to be sure, but still pretty enviable when you compare Australia to other developed world economies. But as expected, we're going to get wider budget deficits and a return to deficit, and wider deficits in 2027 and 2028 as well. Let's take a look at how Australian assets are tracking. As I mentioned, this was well forecast. We do have the ASX just nudging a few points higher after about 41 minutes of trade. We've got the Aussie dollar holding pretty steady, 63.38 at the moment. Still to come, we're going to hear why BHP CEO Mike Henry expects uncertainty in the short term as Donald Trump moves back into the White House. His outlook for the mining sector next. This is Bloomberg. All right, let's just bring you up to date with some of the news from this reported discussion about a potential merger between two of Japan's larger car makers, Honda and Nissan. We have now got some comment from both companies. I want to start with the Honda vice president. He says it is true that there is a merger being mulled between Nissan and Honda, but various options are being considered, and that includes a merger with Nissan. And those were some remarks made outside the Vice President's residence in Tokyo a little bit earlier. Now, as for Nissan's part, here are their comments. Yes, they have entered into discussions regarding business integration, but this matter was not announced by the company. Okay, so slightly more equivocal comments from Nissan there. Nissan's not going to be trading at the top of the hour when we get going in Tokyo, but take a look at those ADRs traded out of the US, rising by almost 11.5%. Honda ADRs also higher. If this tie-up does go ahead, it's going to create a company to rival Toyota in terms of scale. So that Nissan trading halt, meanwhile, that's going to end at 8:55 a.m. Japan Standard Time. Well, Australian Treasurer Jim Chalmers has delivered a budget update, as I mentioned a moment ago, and it reflects challenges, including China's slowdown and weaker domestic growth. For more, economy reporter Swati Pandey joins us now. So, Swati, what new information did Jim Chalmers reveal?
One of the biggest things that economists were watching out for was what happens to the underlying cash balance or deficit, whether the government is trying to make it smaller or is it expected to grow. And in bad news, it's expected to grow. We are seeing a blowout in spending by government, even though Chalmers keeps talking about responsible economic management, and he did deliver two back-to-back surpluses, which were the first for Australia in 10 years. We are seeing a deterioration in the budget. We also are seeing forecasts for a slowdown in immigration, which was expected as well, and economic growth is expected to be slower. It's expected to pick up from where it is right now, but they have downgraded projections for GDP growth as well.
So let's talk about Australia's unemployment rate. That's at a low, very low, 3.9%. The economy's kind of chugging along, but growth's quite anemic. So why are budget deficits continuing to rise?
The government is spending a lot on healthcare schemes, and there's a disability scheme called NDIS in Australia. They are talking about unavoidable spending pressures, and healthcare is a big part of that. Aged care is a big part of that. They have also seen a blowout in infrastructure costs, so for road projects and train and metro, and this is a problem that Reserve Bank Governor Michelle Bullock has spoken about as well, in terms of elevated costs, but also costs of some of these projects rising. And the RBA itself actually has faced this as they are renovating their own building. So this is an Australia problem, and it is reflecting in the budget as well. There could have been probably some areas where the government could have tried to cut back on spending, but this is election year 2025, and so they want to keep giving out those cost of living measures to households as well. So there is that spending which is affecting the underlying cash balance too.
All right, Bloomberg Asia Pacific economy reporter Swati Pandey there. Well, BHP CEO Mike Henry says the mining industry is bracing for the unexpected as President-elect Donald Trump returns to office. Speaking on the sidelines of the Conference de Paris, Henry gave us his view of the potential impact.
For our industry, over the long term, we expect growing demand for key commodities to continue unabated. However, in the near term or along that path, there is going to be a degree of uncertainty related to trade flows, tariffs, industrial policy, and so on, which are something that we keep a very close eye on. Specifically in respect of the incoming administration, we know that there's strong support for mining, strong understanding of the need for security of critical mineral supply chains. Exactly how that plays out in practice and policy, yet to be determined. There has been bipartisan support in the U.S. for more mining in the U.S., permitting reform, and we expect that to continue and to be a strong area of focus for the new administration.
But does that change actually the way you'll run BHP?
So BHP's strategy is one that is very long-term, focused on the global level. The U.S. isn't currently a big market for BHP. It's about 3%, 4% of our revenues. But of course, the U.S. plays a key role in determining policies that apply to the industry globally. So it's something that we stay very close to. Our strategy is one of positioning ourselves in the right commodities, large assets that we can expand over time, specific focus on copper, potash. We've got a big development underway in Canada. Iron ore, we have the world's lowest cost, best performing iron ore business, and in a subset of only the best quality coals for steel making. The other thing I would note is that BHP's production is almost exclusively from countries that have free trade agreements in place with the U.S. currently: Australia, Chile, and Canada.
What does a Trump presidency mean for the energy transition? Does it actually slow it down? And so does it mean that everything is a little bit slower, even access to these critical minerals, that you have a bit more time? So
it's a really interesting question, and I don't think this applies just to the U.S. If you look at governments around the world these days, they're facing competing pressures. I think there's a broad understanding of the need for the long-term need for the energy transition, but at the same time, policymakers are needing to deal with cost of living pressures, resurgence of industrial policy, trade protectionism, all of these factors coming to bear, and how governments then weigh up and balance between those factors in the short term, of course, is a key consideration, but I don't think it detracts from the long-term trajectory of the world achieving the energy transition.
That's BHP CEO Mike Henry speaking with our colleague Francine Lacroix. Got some breaking news now out of Japan. It is trade data for the month of November, and it's a pretty handy beat as well. The deficit is 117 billion yen. The market was expecting much bigger deficit than that of 687 billion yen. So a big narrowing of the deficit there. A huge improvement on the month prior as well. Reason why? Exports increased more than expected. A 3.8% jump in exports. The market was expecting a 2.5% increase, but the real news was a big contraction in imports of minus 3.8%. We were expecting to see a modest expansion there, so a huge reversal in imports into Japan, falling 3.8%. Exports to the US, meanwhile, also contracted by 8%. That might help in the event of the incoming Trump administration. Exports to China, meanwhile, out of Japan rising 4.1%. So some fairly strong trade numbers there out of Japan. You see the yen there, a little changed, 153.49 at the moment. We have more ahead on the Asia trade. This is Bloomberg. All right, let's bring you an update now on the story about Nissan and Honda. Of course, there was a report in Nikkei that the two are negotiating or considering negotiating a potential tie-up. Now, we've heard from both companies since then. The joint announcement says, as announced in March of this year, Honda and Nissan are exploring various possibilities for future collaboration, leveraging each other's strength. Stakeholders will be informed of any updates at the appropriate time. Nissan executive said earlier that nothing has been decided. We are considering a possible merger with Honda Motor. Honda, for its part, says it's mulling various options with Nissan and Mitsubishi Motors. A merger is one of those options on the table, but again, nothing decided. Now, we also heard that Nissan will be suspended from trading at the beginning. That trading hold is expected to be lifted just before the open in Japan, so we should see Nissan stock move. Certainly moved in the US. Look at those ADRs up by almost 11.5% as this story broke. Honda ADRs also moving higher by almost 1%. So keeping an eye on both Nissan and Honda at the open in Japan. All right, let's take a look at how we're doing elsewhere. Here in Australia, we've got the ASX pushing a little bit higher by about 0.1%. If we take a look at Nikkei futures, they are expected to open slightly softer, off by about 0.5%. S&P futures broadly flat as we await the Fed decision. And we are expecting, of course, a hawkish cut there of 25 basis points with a pretty close focus on what comes next in terms of a new dot plot. All right, some stocks we're going to be watching ahead of the open in Korea and Japan shortly. Stay with us. We'll be watching those automakers, of course. More to come in a moment. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens as investors brace for two major market catalysts today. The Fed expected to cut rates while the BOJ is expected to hold rates steady. And we already had some solid data from both economies with U.S. retail sales polls seeing solid growth. And of course, we had those export numbers out of Japan surprising to the upside.
Yeah, lost in all the noise. There's also a couple of other central bank decisions today as well, Shery. Thailand expected to stay on hold at 2.25%. Indonesia also expected to stay on hold as well. But we've got a lot of stock-specific stories coming out of Japan today as well. The Kioxia debut and, of course, this potential tie-up between Honda and Nissan.
Yeah, take a look at how we're setting up for the market opens in Japan, because we had seen the Nikkei now lose ground for 3 consecutive sessions. And as you said it's a busy and noisy day because it's not just setting up for the BOJ rate decision as well, but Kioxia Holdings, the pioneer in NAND flash memory, listing on the Japanese market. But we'll be watching the reception, of course. Their valuation has decreased significantly. There's always the potential of tariffs in that sector as well. But the big news really overnight, local media reporting that Honda and Nissan are preparing to start negotiations on a possible merger, which could include Mitsubishi as well. And this, of course, coming at a time when they've already downsized their global partnerships with other car makers, including Renault for Nissan, not to mention GM for Honda as well. This is expected to provide them with more ammunition when competing against bigger rivals. You can see Honda right now gaining slightly 0.4%. The company has already said that they sort of had mentioned that they would be collaborating closely with Nissan and Mitsubishi, and combining the strengths of each company would be a key way forward, as announced in March. Mitsubishi Motors and Nissan unchanged at the moment, but of course they will have a lot to gain from this partnership as well. For more, Macquarie Capital's head of Asia Autos, James Hong, joins us now. James, good to have you with us. I mean, what can we expect in terms of gains for all of these automakers if they actually go into a merger? We know that Nissan hasn't been doing great, but what's in it really for Honda?
I guess for Honda's perspective, the biggest benefit is actually the scale. I mean, currently, under the current management, Honda has been chasing some of the collaboration and the bigger scale. Clearly, the GM partnership is one of them. They've been working with the Sony recently on Afrila brand. that there has been clear change on the company's the management on focus on the scale and the operation. I guess that's what Honda is expecting to gain from this partnership.
Is there anyone that could potentially object to this deal?
Well, I mean, we understand the Honda management is also considering the overall tie-up. I guess when it comes to like capital alliance or some of the investment holding, I guess that still remain uncertain. But at the end of the day, for the Honda and Nissan, or even for the Mitsubishi management, we clearly understand that all the company understand the needs for the larger scale and more on the powertrain-related technology transfer between these companies. So, no, I guess.
To what degree is this a reaction to competitive pressure from Tesla and some of China's automakers, particularly in the EV space?
Well, we've been actually highlighting a large overcapacity issue in China with the very strong EV adoption taking place by local company taking over the international brand. And clearly the Honda and Nissan and even Toyota to a certain degree is not an exception to that. When you look at the Honda and Nissan, they've been losing the market for some time already, with the sales volume declining 30–40%, and their utilization in China is only hovering like 50–60%. So there has been a large pressure on this management to optimize capacity in China. And obviously losing one of the most profitable market means that they need to do something, and they need to work together to overcome these uncertainties. The situation quite similar in other regions as well, like in ASEAN, where the Mitsubishi and Honda is quite meaningful. They also see large influx of BYD models or Chinese brand into that region, which may hurt their sales in those regions as well. In Europe and US, there is a mixed signal, but then clearly the emission-related regulation is hurting these automakers, and Trump is now talking more on the tariff side, which will threaten some of the Japanese brand. So these companies need to work together to overcome this threat, in our view. And less about Tesla, is more about Chinese automakers and the EV adoption happening in China, in our view.
What are the implications from this, if it goes ahead, for Nissan's relationship with Renault?
Well, I guess as you mentioned earlier, the partnership with the Renault already wasn't that smooth from last round of change on their midterm strategy. I guess for Nissan, their partnership with the Renault has not really done that well. I mean, there has been no meaningful gain or improvement on these, like in terms of technology or product front, or even in terms of like geographical market front. So for Nissan, I mean, working close with another Japanese partner might be a good thing. And clearly that's what the Japanese government and the stakeholder are basically asking for these two companies.
So we talked about competition with Chinese car makers and Tesla as well. How are these Japanese automakers doing right now when it comes to both the Chinese and the U.S. markets? And what's the outlook if they were to compete separately?
Yeah, for U.S. market, I mean, Honda is doing great. I mean, they're benefiting from the larger broadening hybrid lineup, which actually helped them to enjoy very strong profitability and sales growth and market share gain in the market. On the other hand, for Nissan, I mean, the product lineup are aging, and they lack of this hybrid offering, which actually kept them in a market share loss condition, as well as a profitability deteriorating. In terms of China, which is actually the biggest concern for these companies, the local competition is hurting these automakers. So China side, none of these two companies are actually doing well. They've been seeing a 30–40% decline in sales volume. We do expect both companies to come up with a very large capacity cut, to at least to cover some of the fixed cost burden they have in the Chinese market. So U.S. great, with some of the uncertainty with the tariff, and Nissan struggling with the lack of hybrid. China side, both companies, regardless of their hybrid offering or BEV offering, they're actually struggling quite badly in China at the moment. So it's a kind of mixed bag.
James, is that why, given the headwinds in both markets and the competition as well, in your notes, I can see that you say you're more positive on Korean automakers like Kia and Hyundai than Japanese ones, and the order of preference is right now Kia, Hyundai, and Honda. Can you explain to us your rationale?
Well, it's mostly due to how much overlap they have with Chinese competitors. I mean, the problem is that the Chinese brands are leveraging very strong the scale they enjoy in local market with obviously very deep and broad EV value chain there. So they're actually exporting this cheaper alternative and taking over the market share from the international brand at the moment. So we like Korean not only because they're actually doing better in BEV space in the developed countries like Europe and US. But the thing is, they don't have market that are competing directly with the Chinese at the moment. So it's more of like us picking the winner outside of Chinese, or us try to have company with the minimum exposure to the Chinese competition. Honda, I mean, the one we like among the Japanese automaker are obviously due to the very strong free cash flow generated from two-wheelers, valuation being cheap, and also the management has a very strong willingness to return to the shareholders.
James Hong, good to have you with us, Macquarie Capital's head of Asia Autos, as we continue to digest that potential merger between Honda and Nissan. And we're also following Kioxia right now. Of course, they've just debuted in the Japanese market, and they are now rising more than 1% above their IPO price debut. And we were watching right now the valuation very closely, the price as well, and just demand for this stock, given that this is a company, a pioneer in NAND flash memory, but the valuation has decreased significantly in the past few years, now valued at around $5 billion, a fraction of what its previous valuation used to be. We have seen investment faltering in the company, parent Toshiba really wrestling with years of scandals and crippling losses as well. And the listing was very complex and wide-ranging negotiations that involved Bain Capital, SK, and Western Digital, not to mention the Japanese government. And going forward, of course, you potentially have as well U.S. tariffs, not to mention NAND memory price slumps and that recovery that we're watching very closely. We're also watching the South Korean market. Take a look at how it's coming online. Early in the session, we are seeing gains for Korean stocks. This after 2 sessions of losses already. The won has sort of stabilized, but we're seeing a little bit of weakness against the U.S. dollar at the moment, of course, as we continue to follow the latest political developments in South Korea, including the joint probe into President Yoon Suk-yeol. And he's been asked to appear today in court for questioning over alleged insurrection and power abuse. But, of course, Paul, we've been reporting on this the past week, and we'll continue to report on it because it's really not done. I mean, he's been impeached, but, of course, you have to follow the Constitutional Court as well.
Yeah, plenty more to run in that story. Let's see how we're tracking here in Australia. Been open for just over an hour now. We're moving modestly to the upside. The ASX better by about 0.25%. We're also seeing a rebound in the materials sector. It's had a rough couple of days. The worst performing sector right now, oil. Not seeing a lot of movement on yields for the 10-year. Still stalling out really near a 1-month high as we await that Fed decision. The Aussie dollar unchanged, 63.37. Take a look at the oil price. I mentioned energy stocks in Australia not doing that well. We have heard from Kazakhstan planning to increase output in 2025 in defiance of the OPEC Plus agreement to curb production. We've got more ahead on the Asia trade. This is Bloomberg.
Take a look at some big movers in the Tokyo session as we continue to watch the potential merger between Honda and Nissan. We're seeing Honda now starting to trade to the downside of 2%. We're talking about the worst day in about 2 weeks, as we heard from sources that Honda and Nissan are preparing to start negotiations on a possible merger. And this, of course, would create a huge rival to Toyota. We're seeing Toyota gaining 1.5 0.5% at this point as we await trading for Nissan and Mitsubishi right now unchanged. And this, of course, coming at a time when Japanese automakers are facing big challenges, and we have seen Honda and Nissan downsize their global partnerships with Renault and General Motors as well. The big story also that investors are bracing for this week, of course, is the Federal Reserve expected to cut rates, not to mention the Bank of Japan expected to hold rates steady this week. Let's bring in David Chao, global market strategist at Invesco. David, so what are your expectations this time going into these two big rate decisions? It seems most investors have already made up their minds about what these two central banks will do.
Sure. While I think that the market expects that the Fed is going to cut, I'm in the mindset that I don't think that they should. Given the robustness of the U.S. economy, we haven't seen further cracks in the labor market to be that worrying. The disinflationary process in the U.S. continues to come down. So I'm in the mindset that there are members on the FOMC that I'm sure would want to pause and to perhaps save some dry powder in the coming months, especially if there's some bit of economic policy changes with the new White House administration.
And given what the markets are pricing right now, it seems a dollar strength is inevitable, especially if you have the BOJ, on the other hand, being gradual as well, not to mention the ECB, of course, cutting. What does that mean for Asian markets, which, of course, will feel also the pressure on their currencies?
Well, I think that could be one reason why many Asian central banks have decided to pause for the foreseeable future. They need better clarity on the monetary pathway for the Fed. And it's very possible that this could be the last Fed cut for a while before the Fed starts to take hold of what has happened so far and maybe start cutting perhaps closer to the middle of next year. But I'd say that it's idiosyncratic in terms of the U.S. dollar and the basket of currencies. U.S. dollar could weaken against the yen. As we know, the BOJ is on a rate hiking path and could also weaken against the Great British Pound because the Bank of England is cutting perhaps on a slower pace. But it's likely to strengthen against the euro and perhaps another, other Asian currencies.
David, in terms of what's ahead in 2025, you'd be bold to make predictions. We've got the market pricing in about 3 cuts now, according to this chart on the Bloomberg terminal. However, our guest last hour said, there's not a non-zero chance that the Fed starts tightening into the end of next year. Do you consider that to be a realistic possibility, and what sorts of factors might lead us there?
Sure, that's not in our base case scenario. We still think that the Fed cuts to the neutral rate, say around 3.5, 3.75 by the end of next year, and that's because of the disinflationary process in the U.S. While it's still very likely that economic policies put forward by the White House for next year could cause inflation to jump around, whether if it's on the tariff side or on the immigration side, we just don't know. But it's in our base case that we still expect rates to come down in the U.S. for next year.
What's your growth outlook for the U.S.? Because things are certainly looking fairly robust at the moment.
Growth is expected to slow in the next few months. But I think reaccelerate in the second half of next year. Overall, there was perhaps too much pessimism for 2024 that the U.S. economy would hit a bumpy landing or even these potential recession fears. Those were misplaced. We saw a bit of a soft patch in that August-September time period, but that was more of a blip instead of a trend. But overall, the resilience of the U.S. economy is likely to remain for 2025, which is why we've upgraded our view for our investment outlook. We become more risk tolerant in the coming year.
David, what's your view on the yen carry trade right now? What does positioning look like? And is given the weakness and the resilience of the U.S. economy and the weakness of the Japanese yen, is there a possibility that we might see something like what happened in July?
Well, I think what happened in July was that there was not enough communication or gesturing from the Bank of Japan in terms of the monetary pathway forward. I think since then they've done a much better job telegraphing their moves. I think the BOJ is likely to sit on their hands at this monetary policy meeting, and then also signal that rate hikes could be coming very soon, but in a very gradual way so that it doesn't surprise the market. Overall, the Japanese economy strengthening. The most recent 10-month survey from the shows that small enterprises have not been impacted by rate hikes.
Yeah, Dave, you know, the Japanese yen was usually considered a safe haven, but given BOJ policies, we haven't seen that strength anytime we have any sort of global volatility. It's interesting that in your notes you're putting periodic flights to safe haven asset classes, given, of course, the risks ahead. And then you're talking about these safe haven asset classes as the dollar, gold, and crypto. Is this belief in crypto as a safe haven also because of what the Trump presidency could bring for the space? I mean, how does trading crypto really make a difference when it comes to the global market picture going into 2025?
Sure, I'd say that crypto is now becoming a more readily acceptable store of wealth, whether it's for household individuals, but also companies. With large competitor asset managers allowing holding or trading crypto a lot more easy. Now, I'd say that in general, given what's been going on with fiscal budget deficit fights from places like South Korea, France, Germany, it could even happen in place in the U.S. in the coming months as well. And I think that would certainly cause market volatility. And investors are probably more likely to look at holding crypto in the coming year versus 2024.
All right. We thank David Chao. Thanks so much for joining us. David, Global Market Strategist at Asia Pacific at Invesco. We have more ahead on the Asia trade. This is Bloomberg. As investors await the Fed rate decision, Bank of America CEO Moynihan's warning that the US economy may not need too much stimulus. Moynihan spoke exclusively with Bloomberg about where he's seeing signs of strength, including in the consumer sector.
And if we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted. And a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a balance. Anything, it's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm, there's discussion, but everything's still out there until the policy gets enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for the 2-week period around the holiday, Thanksgiving holiday, it's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Bank of America CEO Brian Moynihan speaking exclusively with our colleague David Weston. This as we continue to watch some big movers here in Japan. We are now seeing Mitsubishi trading and surging early in the session today in Tokyo. This, of course, on news that Mitsubishi could be part of a Honda and Nissan merger. We are hearing from sources that they're preparing to start negotiations that could include Mitsubishi, and this would really consolidate Japan's auto industry into two main camps, one controlled by Honda, Nissan, and Mitsubishi, and another consisting of Toyota Group companies. This is a time when Japanese automakers are feeling more pressures globally, especially when it comes to competing with Chinese automakers, not to mention Tesla, in electric vehicles. We have more ahead on the Asia Trade. This is Bloomberg. Take a look at some of the big moves in the Japanese market right now. We are seeing Honda seeing its worst day in about 2 weeks, down more than 2% at one point. Mitsubishi right now surging, best day since 2022. This, of course, as sources now telling us that Honda and Nissan are preparing to start negotiations on a possible merger, and that could include Mitsubishi. Nissan at the moment is untraded, and we're watching Toyota as well because we could see if this merger goes through, an auto industry here in Japan that might be divided between two camps, Honda, Nissan, Mitsubishi in one, Toyota and its subsidiaries in another. We'll continue to watch the market moves as we're also watching another company today, Kioxia, rising above their IPO price in their debut listing on the Japanese market. This is the pioneer in NAND flash memory, but their valuation has decreased significantly, and we continue to see those gains towards 2% today early in the session. Now, Bloomberg Intelligence Technology senior analyst Masahiro Wakasugi joins us now for more on this story. And Masahiro, what do we know about Kioxia? Because we were a bit concerned about a potential cool reception to this listing, given how much their valuation has decreased and how much they've suffered over the years.
Yes. Kioxia is a pure NAND flash memory or SSD solid state drive supplier. So people tend to compare Kioxia with some other memory chip companies such as Samsung or SK Hynix or Micron. And Samsung, SK Hynix, Micron, they have both DRAM and also NAND flash memory. And Kioxia has only NAND flash memory. So currently, AI demand is pretty much benefiting DRAM demand, right? Including HBM. But Kioxia may be benefiting from AI servers, but the benefit is a bit smaller than compared with Samsung or SK Hynix or Micron. So that might be the major differences between these companies.
Is that why we have seen that valuation decrease over the years, and that perspective of Kioxia's competitiveness in the future sort of be dampened by the fact that they're not really diversified?
Yeah. So if we look at the demand trend over the past 1 year, so we actually saw the demand for DRAM increased and pretty much significantly. And we were waiting for some kind of demand recovery for NAND flash memory, but the impact was not very big at this point. So on the other hand, smartphone demand may not be so strong. So some people might be a bit concerned about the pricing kind of erosion for the NAND flash memory chips recently. So that might be causing some kind of the price, the fast price, I guess.
All right, that is Bloomberg Intelligence Technology Senior Analyst Masahiro Wakasugi there. Let's take a look at how we're tracking on Asia markets at the moment. Here in Australia, we're seeing some modest gains, better by about 0.1%, but the Nikkei slipping backwards a little, off of 0.5%, and it is a bit of a mixed picture for those two big automakers that we're watching on news of that potential tie-up between Honda and Nissan. If we take a look at the Kospi, meanwhile, we're seeing some modest gains there by 0.5%, and of course the political situation around impeached President Yoon continues to unfold. Well, Chinese companies are rushing to overseas markets to seek higher profit margins as the domestic economy struggles with weak consumption. Bloomberg Opinion columnist Shery says the era of making easy money from China seems to be behind us. She joins us now from Hong Kong. So, Shery, is it time to throw in the towel and give up on China entirely, or is the story not quite over yet?
I think, Paul, it's a next generation of stories. Basically, Chinese companies, they really like to go overseas because what they see is a more benign market and the higher profit margins. And even though the government said, oh, you know, they're going to crack down on fierce price competition and overcapacity at home, it's still not going to happen. So what we are seeing, for instance, with the electric vehicle makers, right? The Chinese companies not only are making more EVs than any other countries' manufacturers, but also they're reshaping consumer demand. For instance, these days, you know, digital experience like big drop-down flat screens and voice controls, they matter as much as horsepower, and that basically leaves European automakers behind. And there are a lot of other examples, like we can see Chinese milk tea chains everywhere in the world, from Paris to Frankfurt to New York. They just all want to go out. And what it means is that a lot of companies that are stuck in the middle in the US and Europe, they're going to face a lot of competitive pressure.
Shery, let me just turn to Japanese automakers here for a second, because, of course, they've been really struggling to compete with Chinese EV makers as well. But you can see right there that Nissan has now started trading and gaining as much as 24% at one point to touch the daily limit. And this, of course, has to do with the potential Honda and Nissan tie-up that could include Mitsubishi as well, which is why we're seeing Mitsubishi seeing its best day since 2022 and Nissan seeing its best day on record, while Honda is right now seeing its worst day in 2 weeks and falling about 2%. But surely the point being that they really want to compete with bigger rivals. If we do actually see this consolidation in the Japanese market, we could see these car makers compete successfully with Chinese automakers. That's a hope, it seems, from the leadership. But these Chinese companies, as you said, are making not only EVs, they're making phones, selling clothes, home decor online as well. How much of a threat do they pose to actually Magnificent Seven members, including the likes of Amazon, Tesla, or Apple?
I think these names, they're magnificent for a reason, right? Because they're just really good companies. So I think like Amazon should be doing pretty okay. And by the way, 60% of their profit comes from the cloud services. It has nothing to do with the retailers. But for me, like one rule of thumb is like the American companies that can do well in China, chances are they can survive elsewhere. But those that cannot survive in China, I just think they will have a very hard time. And then there are a lot of names, right? Like in the retail space, for instance, like Macy's is not doing great. Target, they're selling a lot of discretionary home decor, and they can easily be replaced by Tmall or Miniso in the U.S. Like automakers, like what you were saying, like the Japanese automakers, I think consolidation by itself is not sufficient. They also need to see that the consumer demand has changed, has shifted, especially in Southeast Asia. Like consumers there, they also like to have those big screen TVs in their cars, and the Japanese automakers, they need to cater to that.
Shery Ren, our Bloomberg Opinion columnist there. We do have more ahead on the Asia trade. This is Bloomberg. Big moves among Japanese automakers right now, with Honda seeing its worst day in about 2 weeks, while Nissan is seeing its best day ever and touching the daily limit. Mitsubishi Motors also gaining ground on news that we could potentially see a merger between Nissan and Honda, a partnership that could be extended to include Mitsubishi Motors. We heard from the executive vice president of Honda that they're considering several options, including a merger, capital tie-up, or the establishment of a holding company. This, of course, as you can see on that right panel, the Japan auto stocks have been lagging global peers. And of course, there's competition with those global peers that's very important, the likes of Chinese EV makers, Tesla, not to mention perhaps also South Korean companies. Of course, South Korea is dealing with its own issues right now and ongoing political uncertainty. Now, the police have asked impeached President Yoon to face questioning today over alleged insurrection and power abuse. But Hyunhap quotes Yoon's lawyer saying he has no plans to show up. Our reporter Min Jung-lee is in Seoul with the latest. Min Jung, what does this mean going forward for these investigations then?
It definitely means like we have more interesting developments coming. We have seen on multiple occasions that President Yoon has no plans to give up his position and will continue to fight. And I think the latest reports kind of support that view, that he will continue to fight for his position despite the continued protests against him and all these other protesters kind of against what happened in the past. Yeah.
So, Min Jung, what's happening with the Constitutional Court? Because there are still some vacancies on the bench. How quickly can those be filled, and how quickly can this process be expedited?
Yes, that's another big question that needs to be answered. It is not impossible for this to go to court with just 6 judges, but I think it is possible. It is more likely to see us moving towards appointing at least 1 or 2 judges before we bring Yoon to court. But there's a lot of questions surrounding this, and it depends on a lot of different moving parts. So we'll definitely have to see what happens going forward.
And Min Jung, of course, we have seen very extreme and drastic political events in South Korea over the past few decades, even with the dictatorship before, with the military afterwards, with the onset of democracy. And I know that you've written about this and this perhaps 빨리 culture, like we call it in Korea, hurry. Tell us a little bit about the gist of what this is, this trend and tendency in South Korea that could potentially heighten this political uncertainty.
Right. I mean, every culture has its uniqueness, and for us, just like you mentioned, we have this culture called 빨리, which is a reference to how everything needs to be done very fast and efficiently. And if you think about it, it took only 11 days since Yoon Suk-yeol declared martial law until he was actually impeached, which is a very short amount of time. And there is this innate culture among most of us Koreans to do everything fast and really efficiently, and this declaration of the martial law really triggered a huge momentum among Koreans to bring this energy together and really move things forward in the way that people really wanted to. And this kind of innate culture will probably continue to be a force driving changes in Korea. So definitely it'll be interesting to see how things evolve from here.
All right, our reporter in Seoul, Min Jung-lee there. Well, the political turmoil in South Korea also throws the current government's embrace of nuclear energy into doubt, and that's as Japan winds back its decade-long policy of reducing dependence on nuclear power, aiming to increase its use to 20% of the nation's energy mix by 2040. Bloomberg NEF's APAC head of research, Ali Izadi, joins us now. So, Ali, how does the Korean political turmoil impact the government's energy strategy?
Minimum, it will delay National Assembly approval for the 11th Basic Plan for Electric Supply and Demand. This is a plan that's supposed to be finalized before the terminal had started, and it lays out the government's target out to 2040. It does require National Assembly approval. It remains to be seen whether that can be achieved. It's also worth noting that even outside of political turmoil, unfortunately, Korea's energy policy has already been a bit of has lacked certainty. Every time there is a new president in office, there's a significant shift in policy due to the strong role that the executive branch plays in appointing the leadership of the state-owned energy companies, which again dominate the energy market. So we saw this between sort of the Moon administration and the Yoon administration, a significant shift away from renewables in favor of nuclear. If the current opposition leader, Lee Jae-myung, finds a path to the presidency, then we may see a bit of a swing back in favor of renewables and reduced favoring of nuclear power.
And of course, the Japanese government itself also, the expectation of new nuclear power plants coming online. This is going to be a big topic when it comes to trying to get those cheap sources of electricity generation in 2040, right? What is your view when it comes to the competitiveness of these plants in Japan?
If you look at the reports that the advisory committee to the government published on Monday around levelized cost of electricity generation, if I may be blunt, they're overly optimistic around the upfront cost requirements and the financing cost of nuclear power plants, while somewhat pessimistic around renewables, particularly around their system integration costs. Now, full disclosure, the committee does use our research. I think just to put this in context, the numbers that the committee reported for nuclear around the range of 11 to 12 yen kilowatt hour for the LCO of nuclear, that would be roughly, once we adjust for inflation and price fluctuation, about half the strike price the UK have to offer under the contract with defense scheme to get the Hinkley Point C nuclear power plant financed. The reason for this is that as most OECD members haven't been building new nuclear power plants for a long time, the projects tend to be delayed and go over cost, which increases the upfront cost. But also getting them financed, particularly by commercial financial institutions and private financial institutions, tends to be more challenging. So the numbers that they're using in coming up with these calculations, while theoretically possible, it remains to be seen in reality. If, for example, they go ahead and say, hey, we're going to offer you a 40-year contract at 12 yen per kilowatt hour, whether there will be any takers to actually build such new nuclear power plants.
Ali Izadi, BNEF APAC Head of Research. Good to have you with us. If you missed any part of this conversation, TV Go is your function. You can watch us live and watch past interviews. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages as well. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
Almost 40 brokers called it quits in Hong Kong this year, marking another difficult year, even after measures to boost liquidity and Chinese stimulus helped revive trading. China correspondent Min Min Lo joins us in Hong Kong with more. So Min Min, how bad is this exodus and what would it take to bring them back?
Yeah, this is the third consecutive year that we are seeing these brokerages closing down. 37 of these brokerages stopped trading this year, although there are 6 that resumed trading after a hiatus. And there are a number of factors here. Obviously, there is the lackluster economy in mainland China, really ever since the pandemic, that is weighing on business confidence, plus the crackdown that Beijing has been imposing on the private sector as well. And some of those regulatory reforms, the IPO reforms, that is really cutting the margins for these brokerages brokerage firms. And so we are seeing, yes, there is this increase in cash trading up 26%, especially towards the end of the year after Beijing introduced those stimulus measures. But still, it's the small companies that are really struggling to survive here, even though overall profits for the sector is up. It's really dominated by the big companies. So industry players, the Hong Kong Securities Association is telling us they expect to see more firms continue to close down in the next 2 to 3 years, and we might end up seeing this sector really dominated by the big players.
And yet, Hong Kong deal makers also betting on mainland traded Chinese firms' second listings to try to boost share sale volumes next year.
That's right. We know that Beijing has been pledging to encourage more Chinese companies to list in Hong Kong. And we did see this nascent recovery in the IPO space in Hong Kong this year with a successful listing of Medea and SF Holdings, for example. Those are encouraging signs for other Chinese companies looking to follow suit. And of course, investors are likely to be more open to trade in these companies that they're already familiar with as well. But KPMG is expecting we could see the total volumes raised by IPO next year to increase to $15 billion, up from $10 billion this year. But that is still less than half of what we have seen before the pandemic. In the 10 years before the pandemic, annual volumes raised is around the likes of $30 billion. So we are far from there. There's still some hurdles, especially with the CSRC's unpredictable timeline when it comes to approving these IPOs. Those are big hurdles for companies, and also some of the macro factors as well. Trump's policies and tariffs, for example, and Beijing's stimulus measures. Those are all factors that are weighing on company earnings and confidence.
Bloomberg's China correspondent Min Lo there. And we continue to watch some of the big movers across Japanese markets right now, and it's really the auto sector that's gaining everybody's attention. Honda paring back some of those earlier declines, but still down more than 1%, as Nissan is seeing its best day ever and really touching that daily limit. Now, this on news that Honda and Nissan are exploring a potential merger, according to people speaking to Bloomberg. And this merger could be expanded to include Mitsubishi Motors, which is now seeing its best day since 2002. We have heard from the executive vice president of Honda talking about several options being included right now that could be a merger, capital tie-up, or the establishment of a holding company. Of course, if we do see this merger go through, there would likely be two camps in the Japanese auto sector, Honda, Nissan, Mitsubishi, and on the other, Toyota and Toyota Group companies. We have seen these Japanese automakers scale back some of their global partnerships. So we'll continue to watch this sector, as we're also watching South Korean automakers as well. I mean, Japanese consolidation in the auto sector could lead to more competitors, stronger competitors. Hyundai right now gaining 3%, and Kia as well, as we're seeing some broad upside for the Kospi at the moment. We heard from Macquarie Capital earlier today talking about how our guest was really positive on Kia, Hyundai, and Honda, that we have seen Asian car makers enjoying profitability thanks to hybrid electric vehicles, which should at least continue into the first half of next year, especially when it comes to Kia. Macquarie Capital saying that they have a well-balanced and profitable portfolio across different powertrains, and that Hyundai is entering a new model cycle as well in SUVs and also broadening their EV offerings, Paul. But of course, right now, the broader markets are still a little bit of caution in trading, right? I mean, we do have two big market catalysts coming up with the Fed and BOJ decisions.
Yeah, we absolutely do. The BOJ, of course, tomorrow, as we look at how Japanese stocks are trading more broadly, currently off by about 0.5%. And lost in all the noise has been the Kioxia IPO. This is, of course, a manufacturer of semiconductor memory products. It had its debut today. Right now, we do have Kioxia shares performing pretty well, better by 2.5%. The timing's not particularly good. Valuation of $5.2 billion. billion, way less than it was when Bain bought it in 2018 for $18 billion. Also, maybe the timing of this debut not great. Bit of nervousness out there about the potential for trade upheaval under the incoming Trump administration. So that notwithstanding, Kioxia bucking the wider trend, better by 2.6%. The broader Nikkei off by 0.5%. The Kospi better by about 0.7% right now, as we do await more news on the fate of impeached President Yoon. And here in Australia, some modest gains for the ASX. That's it from the Asia Trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen.